Debt is the dirtiest four-letter word for an American citizen right now. We have 25 states that can't balance their budgets and have huge issues on the debt situation. If you're investing for the next year or two, you can keep going. But if there's anybody plans on the next 5 to 10 years, I can just tell you this, at this rate, the way you know life and how you're living within the United States is going to change dramatically for the worse, not for the better.
It's Thursday, the 19th of February, and stocks are slightly down on the day, intraday. Gold is flat. Bitcoin's flat. So not a lot of volatility, despite a lot of volatility in the geopolitical arena. President Trump has announced that a strike on Iran may be imminent within the next 10 days, to be precise. Peter Grandich is here to talk about what's next for gold, stocks, oil, and resource investments. Peter is the founder of Peter Grandich and Co. Welcome back to the show, Peter. It's always good to see you. Welcome back.
Always good to see you as well, David. Thank you for having me.
Let's just start with the news du jour. President Donald Trump said Thursday, that's today, that he will decide whether to launch military strikes against Iran in the next 10 days. So now we may have to take it a step further, or we may not, he said. Maybe we're going to make a deal. You're going to be finding out over the next probably 10 days. He's saying this as, by the way, the largest armada that has been assembled in recent history is currently stationed or heading towards the Gulf of Persia. So that's happening. And at the same time, markets are a little moved, except oil, which jumped 2.5% intraday, seemingly on this announcement, but everything else is kind of flat. Stock markets aren't taking this just to heart, really. Gold isn't going up dramatically. So how are you interpreting this? Do the markets really care about this this remark from President Trump?
I think because his remarks can many times mean different things to different people, even though he said the same words. I don't think it has as much of an impact versus the actual decision of an action, or somehow, which I think is the lesser of two things, that there is some sort of major deal struck. There doesn't seem to be on either side a willingness to do what the other side says needs to be done in order for it not to have that. And he's somewhat semi-committed with, like you said, the amount that has been sent there. Mm-hmm. But it will hang over until his next line, which could be an hour from now. So, like I said, I think people have learned to kind of discount some of the things he says now because it can radically change literally the next hour.
I'm just thinking, Peter, what do you think about the stability of the Middle East overall, especially after this week? Suppose a deal were to be reached. It will be reached in the context of the world's largest navy pointing their missiles at Iran, basically forcing them to make this deal. And so after this passes, I wonder if any such deal would even be honored. That's beyond my pay grade, but I'm just curious as to whether or not this particular event means more stability for the region or not at all.
Well, this has been my opinion on it for quite some time. Certain Arab countries are not going to come out in support of it, but they would sooner see the current regime in Iran gone and a far more moderate type of country being run there. But there's just political and social reasons why they can't come right out and say that, because it'd be like they're almost supporting Israel. There's still not the talk of this, that Israel still may go at it alone, even if the United States doesn't. And so I just think people have become somewhat, especially in recent weeks, pulling back on jumping on the first words of things that Trump says, because they call it taco or whatever they want to give it is. He just has a lot of change in his views on things rather quickly. So that's why I personally don't think this one particular news is an earth-shattering news. If he said, I'm giving him 24 hours or something, then I think it would happen. But 10 days is a lifetime right now for traders, so I don't think they're too caught up in it.
Well, what's propping gold up still? $5,000 is the latest price. 5,000 exactly on the dot right now, Peter. And we'll get to your outlook and what you're doing with resource stocks in just a minute. But I'm just wondering what's holding up gold, if not for the Iran news.
Well, it's in a dramatic once-in-a-lifetime bull market that only corrected because it went parabolic. And as you know, I stepped aside the day before the top because when things go straight up, they tend to have a violent reaction down. We had that reaction down to a number that was in a couple of dollars of my downside target. And now I think it's a building a base type of period. The fundamentals have changed dramatically for gold. People have to understand that other than this momentarily battle of the bulge that's happening in Asia because of the holidays, the physical market has gone quiet. And for anybody that has been short or has been needed to see a large downside, that was their opportunity to try to force the market down to shake out some metal. But outside of that, all the indicators that were bullish for gold all the way up to the first run up to the 54, 5,500 are still in place. It's just it became overextended, it corrected, and now we're going to go through a base billing period. But there's nothing on the horizon for me to say that we've seen the ultimate top in the gold price.
Is there an ultimate top? I'm going to come back to gold in just a minute. So stay tuned and get Peter Grandich's outlook for gold, silver, and resource stocks in just a minute. But is there an ultimate top in the stock market overall? It seems to have been flatlining ever since October. If you take a look at the NASDAQ, which is on my screen, it's been trading range bound since October. Bitcoin, which some people on my show and others have been calling a leading indicator for the stock market, has already been going down since October. And actually, if you look at individual stocks within the Mag 7, some of them have declined more than 20% since October, Peter. So I'm wondering if this is the top. What do you think?
So my advice has been, and it's been on record, that we were going to potentially eke slightly over 50,000. There'd be a celebration by the don't worry happy crowd on Wall Street. Little did I know that the Attorney General would create a new stock sell signal for the next generation with her Dow 50,000 comment. But you're right, it's rolling over. I believe the major top has been put in. And I believe we're going to go into a more consolidated sideways to down movement for the rest of the year in the stock market. And part of that is coming from the underpinning that Trump brought to it last year, with now people feeling his economic agendas are not achieving what it was. And because he tied his so-called success based on the performance of the stock market, there's probably going to even be more pressure to the downside because of that. And therefore, I think those things that you pointed out, that all but likely, because you never say never in this business, we've seen the top in the U.S. stock market now.
Before we continue with the video, let's talk about today's sponsor, Delete Me. Now, most people don't realize how much of their personal information is publicly available. Data brokers collect and sell details like your name, address, phone number, and even family connections. That's why I use Delete Me. It helps reduce that exposure. It takes just a few minutes to set up, and then they do all the work. They scan for where your information appears, verify those listings, and submit removal requests to hundreds of data broker sites. They also keep monitoring over time, since this information can resurface. I've been using it for over a year, and they have reviewed over 325 listings for my information. The reports show exactly what was found and what was removed, which makes the process transparent. Go to joindeleteme.com/DavidLin, link down below, or scan the QR code here, and use my promo code DavidLin for 20% off of all consumer plans. Now, back to the video. And what happens once we reach the top? It could be a number of things. It could be sideways action for quite some time, or it could be a correction. What are you looking for? Margins, yeah.
I'm looking for just working the way lower. I've said that for the rest of 2026 and well into 2027, the market will work lower. How much lower depends on a couple of things. Let's not forget there's still another series of 800-pound gorillas out there, and that is the Supreme Court ruling that I don't think is going to happen until after he makes the State of the Union, because they got to be sitting there in the front row if they happen to rule this Friday about it or early next week. But we still have that. And why I say that's important, if they somehow come out and support it and say, listen, even though what he did wasn't right, we're not killing it all, I think that's in the market. But if they come out now and say that this is all wrong and you got to basically give this money back, it's been concluded now, I think, that anybody has a brain, that most of this money has not been collected from overseas, but it's been taxed here on the United States side. And that's a lot of money for the government to have to somehow come back and start giving back to people. And the ability to do it and how they'll do it would be probably half of a nightmare. So there's a lot of reasons to look for the market. I'll give you one other that no one seems to be talking about. It used to be extremely important. Some people, I guess, in the younger generation don't. I still think it does. We've had a record amount of corporate insider selling, while we had a record amount of public buying of the stock market. And historically, the public was the last to show up at a bull market, and insiders would tend to be the first to get out of a bull market. And I think that's something that's another indicator that suggests what you showed before, that the market is topping out and rolling over.
And this is just to show the annual percent change of non-financial corporate business debt. So it is growing, but not at the same pace as it was in 2020. One of the arguments for why the tech sector has been propped up the way it has been up till now, Peter, is the nonstop issuance of capital expenditures from one company to another. Basically, they've been investing in each other over the course of 2025. Now with AI investments looking like the return on investment is a little bit lower than what some people expected, they're still doing that, but investors' expectations are now tempered somewhat. Do you expect, Peter, that CapEx will continue to prop up AI stocks this year? Because it doesn't really matter what the fundamentals are. If they continue to give each other money like they have been in 2025, then the stock market is probably not going anywhere.
That bubble has burst. I think the biggest trouble in the news that we've had today, a side note, but will indirectly impact it, and that is a very big problem now is coming to the surface in the private credit and equity market, where one of the biggest funds have basically said people cannot have redemptions. It's like telling a bank you can't come and take a withdrawal out. I think that's another indication of how troubling the overall credit market really is in terms of corporate. And therefore, that can't be bullish and help those that still need a lot of money in the AI market.
Peter, which sectors do you like the most right now?
Well, but see, that's just it. I don't have any favorite. I own one stock.
Okay.
I'm basically liquid from that. I do believe and have been looking for a pullback in the mining and juniors to be reinvested in them again. But at this point in time, as we speak today, I'd sooner be cash than any other sector right now. But if there is weakness again in the mining sector, I'll look to get back into it.
Well, why aren't you buying the metals then, Peter? Especially look at this chart. This is silver. I'm just taking silver as an example, but you can see similar patterns across the board. Gold, copper, platinum, palladium, all exhibiting the same selling pattern the same day. You told me offline that the day before February 3rd, I believe, was this big correction. January 29th it started, and then February 2nd it accelerated. So early February, late January was when silver collapsed 30% in a single day, which is the biggest single day drop since 1980. Now that it's already done that, wouldn't you want to get back in? I'm just speculating here. That's a 30% premium that somebody could be capturing if you expect it to retrace previous highs.
Well, if you want to look at it that way, you can also see that since that decline, each subsequent high was lower. And that's why I believe there's still a retest of those lows that were made in the high 60s in silver and around 4,500 on gold. That's what I am looking for at this moment. If I'm correct and it ends up being at that point, I will look to get back into the shares as well. But until such time, I'm comfortable sitting on the sidelines.
Well, you told me offline you issued a note to your followers shortly before this correction happened. It was a warning. People should be taking profits. You told me. How did you know?
A lot of times, still in this point of my career after 42 years, it's more of just a sense of feeling than anything else. But what was really indicating to that was the parabolic rise. All parabolic rises blow up. The problem always is you tend to be too early and they go further than you thought they could. But when we crest at that date, the exuberance and measuring of bullishness was off the charts. And it was just a sense of feeling that that's the time you need to move to the side. Did I think it was all going to happen in one day, David? No. Did I think it can fall 30% from the high? Yes. And that's why I still think we need to do more base building before we can resume. And I still believe it's a very strong bull market, but we need to do more base building before we can at least attempt to go back to those highs and go through them.
Do you share the same sentiment towards resource stocks? You said you're waiting for more of a correction. You see, the GDX didn't correct by the same order of magnitude. as gold, as silver rather. I mean, it's down. It was down 19% during that time, which is significant. But look how it's rebounded since. So it hasn't really lost much since the top. And you're not comfortable buying more at current levels. Is that what you're saying?
The shares are a better choice than the metals, because the ability of profitability for them, the leverage that's going to come from that is going to offer more percentage gains when the metals resume their upside trend. I just feel that there's still a possibility that there can be overflow from the negativity of the general stock market going down that could weigh on those shares. So I'm just looking to buy them back at the lows that they made after the parabolic decline. If I missed it, then I'll just have to count the 2, 3, 400% we made the previous 18 months and live with that.
I want to talk about what will happen to the national economy and subsequently markets once debt continues to climb up. This is a recent report by the Congressional Budget Office that puts out budget and economic outlooks. And they've recently updated their 2026 budget. In changes in CBO's economic projections since January 2025, real GDP growth in 2026 is projected to be stronger. In later years, output growth is generally the same as it was in CBO's January 2025 projections. Nominal GDP from 2026 to 2035 and inflation from 2026 to 2029 are now expected to be higher than previously projected. The forecast of short-term interest rates is generally the same as it was last January. And I read further down that federal debt would equal 120% of GDP in 2036. So higher inflation, perhaps stronger economic growth, but debt to GDP rises. Does any of this concern you at all? Because ultimately, yeah, go ahead.
I'm sorry. So it's the granddaddy of all my concerns.
Okay.
And there's many of them. This is what your listeners need to ask their financial advisor or one of these talking heads that appear on these financial networks and all, to give them the proper answer to this question. The Congressional Budget Office, which you just noted, which just a couple of years ago had it as a $50 trillion target, went to 54, now is at $64 trillion debt target in 10 years or less. And that's with, as you noted there, with no real high inflation or a recession. So it could get sooner. An average interest rate of 5% to refinance such a level of debt is not asking a lot. That's a very reasonable number to say what the government is going to have to offer to refinance that type of debt on a long-term basis. That's well over $3 trillion in an annual interest expense. Up until now, the best year the United States ever had a year ago was $5.2 trillion as revenue. So let's say that gets kicked up for whatever reason, $800 billion, and it's at $6 trillion. Over half of all of that will now go to pay an interest expense. It is inconceivable and impossible for the United States government to run as it currently is now, or better, with such a debt load. So the question is, if the Congressional Budget Office is remotely close to being accurate, most people watching this are going to be in a much more dire situation from a government standpoint than they are now. And yet, from both sides of the aisle, here in the United States, there is not any type of effort at all to even slow this ascent, let alone end it by finally doing what should have been done years ago and have a balanced budget amendment. And so my argument is this: if you're investing for the next year or two, you can keep going. But if there's anybody plans on the next 5 to 10 years, I can just tell you this: at this rate, the way you know life and how you're living within the United States is going to change dramatically for the worse, not for the better, not counting all the other issues that are out there.
Yes, but Peter, look at this chart. This is the federal government expenditures, interest payments. This is what you were alluding to. Higher interest payments if the debt continues to balloon. It already started ballooning, Peter. Since 2020, it's basically almost tripled. almost tripled in the last 5 years in nominal terms, not real terms. Okay, what does that mean? Well, for the average person, please go ahead.
I'm sorry, David. I shouldn't have.
You're very excited about this. We like that.
I am because it's my granddaddy of what I think is wrong here in the United States. Debt is the dirtiest four-letter word for an American citizen right now. It's not just on the federal level. We have 25 states that can't balance their budgets and have huge issues on the debt situation. We have several cities facing that. We have consumers now facing that as well. And we have some serious corporate debt problems that we discussed earlier.
Yeah.
Debt is the killer of killers for anybody that has a long-term bullish argument. Doesn't mean it's going to happen tomorrow, but it's now within a range that most people who will be watching this are going to be alive and have to live through, and most people are not prepared at all for it.
Does it impact actual government outlays is my question. The argument that I've heard is that, okay, interest expenses have gone up. Now they can't afford certain other things. Well, that's not what we've seen, Peter. The government just continues to spend more money. So ultimately, can the average American feel this?
But they were able to spend it while still they weren't at a point where over half of their income had to go pay for that expense. And now it will have to be if the Congressional Budget Office is correct. And here's the other part of what people don't want to reach out and all. This is coming at a time when the American political system has never been more divided other than potentially our Revolutionary War or our Civil War. So there isn't a readily available expectation that two parties during the next financial crisis, which is inevitably going to come because of this, that there's any action going to be able to take to work it into a workable and swallowable solution. And that's the problem because it's being multiplied now because both parties are having a fraction within their own parties. And we haven't even talked about, and you don't have time to talk about the retirement crisis, the infrastructure crisis, so many other crises that we have here in the United States. We're not alone. I think your country has some struggles ahead of it as well. But the problem is we have a president now whose mandate, who he was elected on, was to focus here and now on the issues that faced us. And it has been more of somebody that's focusing outside the United States. And I think that's also going to compound these issues that we speak of, including the debt issue.
What does this mean practically speaking for the average American? Are we going to see higher taxes or perhaps some of our social services cut or other areas in our lives that depend on government assistance cut? What does this mean?
Taxes are going up so profusely, and they're doing it now through sort of socialism type ways. Several states, one just now, people in Massachusetts were shocked to see their electrical bill tripled. And when they looked at their bill, their electrical costs were still basically the same, but 200% more came from a public benefit charge that they passed in their assembly and said and didn't even know it, to where now governments can charge you to pay for other people that supposedly can't pay for the electrical usage. We're seeing that in water, we're seeing that in gas, and that's more of a fee-based way that especially states and local cities are using to collect taxes. And so all of that at a time when 2/3 of Americans are working paycheck to paycheck, they have no room to add any type of disposable income to their wealth, let alone start paying additional taxes and all. It's coming out of an extremely troublesome time for most Americans.
Okay, so how do we prepare for potentially higher taxes, potentially cuts in social services, and much more government debt?
Okay, so in my planning group, when I tell you what I'm about to tell you, 8 or 9 out of 10 people walk out the door and don't listen and go down the street to somebody else. But I'm going to tell you anyway.
All right.
The first is less is more. We have to learn to live with less than what the world tells us that we think we need. The average family in America is living at least one lifestyle ahead of truly of its finances. It does that through debt. It does that for going important things like saving for retirement and education, deferring maintenance to their home in order to have a lifestyle now more than what they potentially really need. The second thing that is that you have to save more than you spend. And that's another challenge for people. And that debt is really a last resort in order, you know, to get something. And we go in the opposite direction. And until that changes, we're just going to continue to have more and more issue. Remember this, the government here in the United States on the federal level has a printing press. You're right. People can argue, oh, they can print more money and create more debt. And yeah, that can go on for a while. But they don't have that ability on the state and local levels. And that's where the real challenge is going to be for the average citizen and where they're seeing the largest increases in taxes and fees versus from the federal government.
Right. And that means what for our assets and the securities that we want to hold?
It makes it more challenging. It's going to be more difficult for the average person to have risk capital when day-to-day things are becoming more impressed on them to have to focus on. 50%, over 50% of Americans now are using some sort of debit system in order just to pay for daily needs, gas, food, rent, etc. That number is increasing. Eventually, even paying minimums on credit cards become challenges. And therefore, there's going to be serious amount of defaults. And also the typical thing that any human being is going to do is going to turn to the government and ask, you have to help me. What can we do? And so it's going to become more oppressed on those that have some wealth to have to pay that lion's share of it. That's why the socialism talks or the hard left of the Democratic Party that speaks of social like issues is getting an ear because those people that are struggling, that's the only ear that sounds like that's an out for them. And they're going to become more influential because more people are falling into that rut and that trouble. And that's why I just think overall it's going to be much more challenging economic, social, and political time here in the US. And therefore, it's going to be much more harder for things like the stock market to rise a lot.
I want to come back to that social unrest to end the conversation. But going back to the debt issue, this is from the same article at ABC News. Americans are carrying a record amount of debt, reports. The nation carries almost $19 billion in mortgage, car loan, student loan, and credit card debt. But it's not just loans going up, Peter. There's this relatively new, it's not exactly new, but a relatively new development called Buy Now, Pay Later programs. This is from the Richmond Fed. The total transaction value of Buy Now, Pay Later BNPL loans, measured in real terms, has grown roughly 20% since 2021, reaching an estimated $70 billion in 2025, or about 1.1% of total credit card spending. This is becoming a more popular instrument. Instead of actually racking up credit card debt or applying for a credit, line of credit or some sort of loan, you're just going into a program where you're financing the thing that you're purchasing, whether it be a TV or I've seen things as little as a meal at a restaurant. You basically, you have the option to finance a lot of things, Peter. Can you walk us through this development? Is it better than holding credit cards, you think?
Well, it's a more dicier. It can be far more expensive than what credit cards could be if you can't make any worthy payments towards it. It's just what inevitable people are left to choose from versus do I even eat? The problem is it's not just that desperado. It's people who could pass up that meal or pass up that item, but have to have it because they feel that's going to make them feel good or whatever the case may be. And that's where the real issue lies. And that's all down to individual choices. And until they can't get that type of credit and extend their life somewhat until paying the piper, they're going to use whatever is offered out to them. And that's the other issue that it's hard to imagine. I come from a generation, my parents never had a credit card. If they didn't have the money to pay for it, they didn't buy it. Now the question is no longer can we afford it? The question is can we make the payment? And that's been the biggest change in society.
I know you're in New Jersey, but in New York, the mayor is considering raising property taxes on I believe most of the residents. I just don't quote me on that. I have to double check if it's a certain income bracket. But basically, the state has rejected his proposal to up the millionaire's tax, and so now he's proposing to increase property taxes. Maybe if that gets enacted, and not just in New York, but across the country, people will be forced to spend less. And so that fixes itself. What do you think?
Well, right now, anybody that can escape has or is going to try to escape from that. We're seeing that happen in a much bigger way out of California now, where billionaires are leaving the state because of the taxation issue. Unfortunately, those taxes still have to be raised, so who ends up staying or can't leave pays the burden of that and all. You're talking about a generational change that would have to take place. This debt has not occurred over a day, a week, a month, or a year. It's been decades. It's been a generation or two of living this way. And until we're willing to go through a much tougher time over a longer period of time, it's not going to be solved in any meaningful manner where you can see relief across the board.
And then going back to this civil unrest that you were talking about earlier, how does this manifest? How does this play out in the next 10 years, Peter?
Well, it's playing out already. People are willing to become more violent oriented than maybe previous generations have been. It's also been well organized. It's being financed by groups and people that are looking to do damage for whatever choices they may have to do so. And they're willing to take it to levels that maybe uh, my so-called boomer generation or even the generation after us wasn't willing to do or get to that level of dislike and hate to seek physical violence against others. But it's becoming more common and it's becoming the choice for people to take action on. And I don't see any way of it slowing down. It's just increasing and it's becoming to some people a way of taking action. And it's hard to change people once they've made an assumption that a certain way of life needs to go a certain way. And that's clearly what these people have accepted, that they're willing to take those type of actions to prove a point or to go against the point.
You previously, on my show a while ago, suggested the idea that the European Union could break up. And I'm seeing articles like this, by the way. This was written last year. This is from the New York Times op-ed. Is civil war coming to Europe? It starts off by basically observing that most of this rhetoric is coming from the right wing, and then basically musing as to whether or not it's actually likely. Now, I'm not saying it's going to happen one way or another, but I'm just going back to your question. Is there still a reason for the European Union to stay together? Perhaps Trump has been a unifying force. It's brought a lot of countries together in defense or solidarity of Greenland a while ago, if you recall.
Well, you're right. I have been a believer. I believe part of that is because the great economic machine that really was the lifeline to the EU, Germany, has faltered greatly, and there's nothing on the horizon to think that they can recover in any shape or form. I don't think it will continue in the manner that it used to. I think there will be a loose knit kind of attitude. You are right. There was some, I wouldn't call it coming together, but there was some meeting of the minds with Trump. But let's not forget, Trump will only be around another 2 or so years. And potentially after this election, he could be watered down if the Democrats at least take the House, if not the Senate as well. But I do think the EU as we knew it is over. And I do think it wouldn't surprise me that more of that right wing type of stuff happens in more countries. And once one says we want to step out, Italy has made the first kind of overtures regarding its gold and not wanting it to be part of the EU. And I think that was the opening blow, and we're going to see more actions like that in the coming months from different EU members.
Well, let's find out what happens next. So, Peter, give us one or two items or news items or developments in the next coming weeks or months that you're following closely that you think can move the needle on markets for you, at least one way or another.
Well, I think for here in the US and the economy still centers around Trump's and his initiatives and whether or not they will be viewed as successful. I think his biggest problem now is his base that he had is faltering and splintering. And because it's an election year now, uh, he will not have as much free chips to play with that might have been, or a honeymoon period that might have said that he had in his first year. And therefore, I think it's going to be more of a strain on the markets than a supporting mechanism. So I still think Trump and Trump's agendas are key factors, especially to the US market. I also think that as I told you, is we are just in a corrective consolidation phase in the metals. I do think the metals still have quite a ways to go. I think silver will return to triple digit. I think gold will make new highs. I would say the one market that is a little bit dampened at the moment is copper because of the buildup of stockpiling, because of the concerns of running out of it. And it might have dampened the price a little bit now, but that will actually enhance the longer term view down the road. And I think the other metal market that got ahead of itself as well is the uranium stocks, pricing in a triple digit uranium price that still the market can't get to. And if we do have a corrective phase in the overall market, that can spill over to them. And but other than that, I still think I would err on the side of metals and energy before I would be looking at technology and growth stocks.
By the way, I've heard from a few of my guests on the show that they're very bullish on uranium and uranium stocks, and also copper and copper stocks because of their role in the AI expansion, especially when it comes to data center construction. Do you share the similar bullish sentiment on
I
uranium and
did.
copper?
I did up until now. I think we're going to be surprised that some of the opposition that's rising against these centers is showing up. We just had a big protest here in New Jersey last evening to actually stop a data center from being built because of the cost of electricity and what the local people have to pay. So I think the bubble has been busted on the AI sector. So I don't think that itself is going to be a reason, but those metals still will work higher over time. It's just that some of the stocks got ahead of the metals price, in my opinion.
Okay. All right. Thank you very much, Peter. We will follow up with you next time. Tell us where we can find your work and follow you in the meantime.
Well, Peter Grandich on X page is primarily my way of communicating, but there is a website, petergrandich.com. And thank you, David, as always. It's always an exciting time to speak with you. You always keep me on edge.
Well, thank you for sharing your thoughts. You keep us informed. So exciting times for all of us. Lots happening. So we'll follow Peter. We'll put the links down below, so make sure to follow him on social media and his website. Thanks again, Peter. We'll speak soon. Take care for now.
God bless, my friend.
Thank you for watching. Don't forget to like, subscribe.